Welcome to our December quarter 2015 review, and I might start by wishing all our clients the best for 2016. Financial markets are obviously not in a festive mood, and I will address that later. But initially I wanted to highlight three market observations from last year. First, the busting of the China commodity myth, reflected in BHP declining approximately 75% from its high in 2011. Second, and directly correlated with events in China, the collapse in the Australian dollar. And third, the busting of the Australian bank dividend myth that in a low rate environment, dividends would support banks, which are now down 30% from their peak prices. This again highlights the fact that when all think alike, no one thinks very much. It was not that long ago, with the Australian dollar above parity against the US dollar, that conventional wisdom was that owning the so-called blue chip bank and resource stocks was all one needed in their portfolios. And institutional investors had to own these stocks as they were such a large part of the index. So again, a stark reminder that when it comes to investing, there is no safety in owning what everyone else owns or is comfortable with. Now, in respect of our currency positioning, the Australian dollar is now at more neutral levels, but still biased to the downside due to the magnitude and expected duration of the commodities downturn. Plus, the US has only just started to raise rates, which is typically supportive of their currency. So medium to longer term, we prefer to maintain our offshore currency exposure. Now, having said that, we do not think that the US dollar will rally significantly from current levels. We also think it has been too early to be buying resource stocks that have still not cut capital expenditure to the bones and are still arguing about the merits of maintaining their dividends. Then again, if they keep legging down 10% on a daily basis, as they have been recently, they may be ready to buy sooner than we're expecting. ASX banks are a tougher call, as the gross dividend yields are compelling, but we are still sceptical about the sustainability and future earnings growth. Thus, we prefer the offshore domestic banks, where we believe dividend announcements and the upcoming year-end results will be the beginning of an upward path in payout ratios and yields. So if we turn our attention to global markets, the big event of the quarter was that finally the Fed raised interest rates. In theory, that should have been positive, but it looks like their indecision over such a long period of time has totally confused the market, especially given the events in China and the collapse in the oil price. Half of the investment world believes it will cause a recession. The other half believe growth will continue. If you believe current stock market action, then we're about to have a recession. Recession concerns are being driven by the now clear evidence that China's economic adjustment will be more painful than the consensus had previously accepted, and the resulting commodity price collapse impact on the US energy sector, the Middle East, Russia and emerging markets. An anecdote on the impact of the oil price collapse is the recent announcement by the Saudis of an expected $100 billion fiscal deficit. Initially, this has to be funded by selling from their sovereign wealth fund, and no doubt this is impacting markets. How much is hard to tell, and they are not alone. All the beneficiaries of China's commodity boom are now liquidating assets. The flip side, however, is that consumers have been given a huge boost to their discretionary spending power, thanks to the collapse in petrol prices, heating, and anything else commodity related. This follows the massive boost they received from lower interest rates, which they appear to have saved much of the benefit. So the consumer is in good shape and should underpin the developed economies. The issue with markets, I suspect, is more to do with the speed of the decline in the commodity prices, particularly oil, and thus we get the pain before the gain. Overall, I expect the impact to be a net positive. China and the commodity complex had to adjust, and the pathway to a more normal environment will purely be a matter of how severe China's eventual adjustment will be. So China is a key issue going forward, and as we noted some time ago, when Greece was everyone's paranoia, it's China, not Greece, that matters. So who knows with China? But overall, we are still expecting a continuation of our much repeated 2 steps forward, one step back economic growth scenario. Growth will be more subdued and valuations, as previously noted, have re-rated. Thus, earnings and market returns will be more subdued. So we want to own businesses that have above normal earnings growth prospects or will provide above normal yield. Our monopoly type service providers fit the bill of earnings growth: Google, Visa, and our futures exchanges. The offshore domestic banks fit the bill of above normal yield if we project forward. I would also note that they are simple businesses with simple investment theses, and that is our primary objective at PM Capital. Otherwise, given the recent correction in many parts of the market, we are on the outlook for something new to add to the portfolio. So in conclusion, again, focus on earnings growth and above normal yield. And with that, I'd like to thank you for your time. And again, all the best for 2016.